Hello and welcome to the weekly commodity market update. Today, Ben and I are going to talk about interest rates along with some energy shifts and prices, and then the upcoming grain stocks report this coming Monday. Ben, good morning. It's a pleasure to have you.
Yeah, it's good to see you too, Will. I hope you're having a great Tuesday. We got some good rains here over the weekend, and so moods are better, maybe.
Yeah,
Is that how I should say that? Moods are lifted.
there you go. Well,
Yeah.
it's been a transitional weekend down here in Texas. Not so much as far as the rainfall, but my fiance and I were moving, so empty apartment here for the most part. Thus, the headset today have to make some changes in technology for the short term. But Ben, looking at some of the changes that we saw coming out of last week in the markets, we saw a big dip to round out the week on Friday, and then some rallies to start this week. But I'm going to give a quick snapshot here on the week to week changes that we did see. So just keep in mind this has a kind of a big dip in the middle, and then it snapped mostly back. But December corn futures up 3 cents in the week at 413. December corn futures for 2025 up 2 cents at 450. November 24 soybeans up 35 cents at 1039. That 2025 November soybean contract up 22 cents at 1079. Soybean oil on a cents per pound basis for December up $2.73 at 41.84. Soybean meal by the short ton for December up $4.90 at 328.70. Looking at that December wheat crop for 2024, up 4 cents at 582. December cotton is up 62 cents at 73.44. And then that West Texas intermediate crude oil contract up 91 cents at 69.93. And I think real quick, I said on the soybean oil is up $2.73, is up 2.73 per pound there. So just want to clarify that. But Ben, a lot of gains all the way across the board, but this picture does kind of cover up that sharp loss and then bounce back that we saw to end last week.
Yeah, it sure does. We've had a couple of weeks like this over the entire time we've been doing this program, but they're pretty rare to see everything up across the board, and that's certainly what we got on those weekly changes or week over week changes. It was largely led by that big rally on Monday, as you mentioned. Coming out of the weekend, maybe a little bit of a drier forecast in South America than what was anticipated. That led a little bit of rallying, and then the fund managers jumped in with some short covering as well. So pulled the whole complex higher.
Well, we saw that, and then we saw a pretty big shakeup in the general economic lookout or just picture overall, looking at what the Federal Reserve did, cutting interest rates by 50 basis points, which was the largest cut coming since 2020. So, Ben, looking at this, big move, what do you think this is going to mean for the general economy and how this relates back to ag in the short and longer terms?
Well, it had to be the largest cut since 2020. It's the only cut since 2020.
It only
So
gone up since then. No.
yeah, it's only gone up since then. We've only had the rate hikes. So the Federal Reserve cut interest rates 50 basis points. This was, I think, the 50 basis points was the big uncertainty heading into the day. Just about everybody believed that that the Federal Reserve, through their language and through their comments, were going to cut interest rates. It was just uncertain of how big. They went with the 50 basis point cut, feeling like the general economy was doing really well. The Fed chair, his announcement was the economy's doing great. Our job's to keep it there. It was interesting. There was one Fed governor that voted against the policy change. That's the first time that's happened since 2006. So Fed governors are traditionally in line with the Fed chair. So I guess we could sit here and say there was a little bit of drama playing out in the Fed meetings, but generally this is where we're at, right? Like we're in this period of uncertainty in terms of providing a little bit of relief to consumers and those that are trying to borrow money to keep the economy going, but also trying to signal that, hey, this is not a move to reignite inflation, right? Like we've worked really hard, or the Fed's worked hard to lower inflation rates. um, we don't want to reignite it like what happened back in the early 1980s, right? The Feds kind of started cutting interest rates and it just reignited inflation, got out of control. So I think the Fed is aware of that. I'm not sure the broader market is. The expectation is for another 50 basis point cut yet this year, plus another 25 basis point cut in November, so after the election. So They're expecting 0.75% to come off again by the end of 2024. And I personally, I feel like that's a little quick of where we're at and some of the general signals we're seeing, but that's what the market expects as of today.
Well, Ben, it seems like a game of perception just a little bit, whenever the Fed looks to move these interest rate levels, because like you said, if you bring it down too quickly, then you could have that chance of reigniting inflation. But a lot of that comes back to maybe people's perception of what is going on and how they react accordingly within the market, but also what, could alter some perceptions. Looking at some adjustments in energy prices, some flips in fuel prices. Just personally, this past week, I filled up at an HEB gas station here in Austin, Texas, and I think it was like 246 to fill up my tank, which was well, it was per gallon, which was the lowest price I paid, in several months. So just looking at the shift in energy prices, what kind of signals do you see coming out of that, and what that could mean for ag producers?
Yeah, so before we get to that question, is that how it's pronounced? HEB? I thought it was Heb. Is it
No,
not
no,
Heb?
no, it's
Oh,
it's definitely not Heb.
oh, all right.
It's
Well,
kind of funny because I feel like a lot of people in Austin aren't from Texas. I'm not from Texas. I'm not trying to claim from being from Texas, but I got down here and I was called an HEB, and I guess I got it right, and then other people definitely wrong.
okay, well, this
But
is me
yeah.
as a Midwesterner thinking it was pronounced Heb, not HEB. Anyways, okay. So back to back to the topic, back to the program. So yeah, you're right. U.S. fuel prices have fallen. If we look at crude oil's down 23%. Gasoline prices are down 18%. Distillate fuels or diesel fuels down 24% year over year. These lower energy prices are going to provide some financial relief to the ag sector and just the broader economy in general. Um, you know, we've got some macro factors here, so slowing expectations of growth in China and other places around the world that have led to a lower demand picture. But then at the same time, we've got the OPEC plus countries that are reducing production to kind of help sustain gasoline or crude oil prices above $70 a barrel. Here in the United States, we've been producing at pretty high rates for both crude oil and gasoline production. We exported a lot over the last couple of years. Those exports are starting to slow down as the rest of the world's, like I mentioned, the Chinese and some of the other countries, Mexico too. They're seeing a little bit of slowdown in their consumption patterns, and so that's slowing down our exports of fuel to the rest of the world, which is allowing stocks to kind of yeah, they're not huge, right? Like the stocks
Mhm.
haven't grown to the point to where like they're burdensome on prices, but it's allowing stocks to maybe see a little bit higher of a picture in the months and weeks or in the months ahead, as we look down the road. On the ethanol side of the picture, ethanol production continues to be very strong. We continue to see good weekly production of ethanol. It's been a bright spot in the corn demand picture, for what seems like 8-9 months at this point. And so that has been something that has helped. And I think with lower gasoline prices, maybe that continues to use a little bit more gasoline demand and also more U.S. based ethanol.
Well, and it seems like a positive on two ends because, on the macro scale, you're looking at maybe increased demand coming from this, but also, during this time of year during harvest, maybe a lot of grains being hauled around in some heavy equipment, and maybe a little bit of better input look out there on lower costs. Well, Ben, looking forward into next week, we have a grain stocks report coming up. What are your expectations for this report? Are there any shakeups that you might see that could impact these harvest time prices?
Yeah, so you're right. So next Monday, the September 30th, we get the September 1 grain stocks report. So even though it's coming in at the end of September, it's really a point in time for the beginning of September. This report is always kind of a little bit of a market shakeup report from the standpoint that for corn and soybeans, this represents the end of the year. So the end of the 23-24 marketing year. Historically, these reports have caused a lot of uncertainty in the market because it's USDA's opportunity to go back and revise all 4 quarters of grain stocks reports. So they can go back and revise grain stocks from last December if they want. If they feel, well, I shouldn't say if they want, if they have the evidence to justify it, they can do that, right? This is the only time of the year where they can do all 4 quarters at the same time. The other thing that they can do and have done in the past and could do again this year is when you get to the end of the year, you have a pretty good idea of what demand was. And if demand or if use was either higher or lower than what you thought, plus, you have either elevated or depressed grain stocks, that implies either a higher or lower yield, respectively, of what production was in 2023. So this is USDA's opportunity to also go back and say, hey, last year's corn and soybean production was maybe higher or lower than what we
Mm.
anticipated. The reason this is important, the reason I think that next Monday is a big deal and could be a big shock to the market, is if you remember back in June, when we got the June 1st corn stocks report, it came at the end of June. It was also the same day as the acreage report. The acreage report for US 24 corn and soybean acreage was the highlight number, given all the flooding that we had in June in Iowa, Minnesota. So that was the big ticket item that everybody was watching for. And the grain stocks number kind of fell under the radar. The corn grain stocks number that came in June was super bearish. It was above all expectations. It was about 130 million, if I remember right, 127, 130 million bushels above expectations, right? And so traditionally, what that has meant is that either demand wasn't as strong during the second quarter as what we anticipated or what we thought, or excuse me, the third quarter, not the second quarter, the
Mm.
third quarter, or 2023 production was actually
Just
higher
way bigger than
than
thought. Yeah.
than what we thought, right? And so USDA can't adjust previous quarters, and they also can't adjust, yield in the third quarter grain stocks, but they can in the fourth quarter grain stocks. What they did, and I'm giving you a little backside politics here, is in July, the expectation was is that they would grow ending stocks of corn, and instead what they did is they increased demand for corn and basically left ending stocks. It actually lowered ending stocks when the expectation was higher ending stocks.
Mm.
And so that was USDA's way of basically banking higher demand in to account for the larger stocks. Well, when you get to September, you can't make those adjustments. There's no room to hide. And so,
Yeah.
quote unquote, this is when the roosters come, this is when the roosters come out, and we actually know what the crow is here, or the cry is, because there's nowhere to hide. And so my expectation is we actually see lots of changes in the core numbers, potentially even a change to last year, the 2023 yield, maybe a little higher. I also think USDA changes feed use numbers lower, and probably grows that ending stocks number because
Yeah.
it has to match. It has to match the
Yeah,
September
there's
1 grain
nowhere else to
stocks.
go. Yeah.
There's nowhere else to go. And so I'm a little concerned that the corn picture especially could be a little bearish come
Yeah.
Monday.
Well, Ben, all that to say, it kind of reminds me of how a quote from the West Wing, and I know this is probably a saying outside of that, but at some point the president says, if you have the facts on your side, argue the facts. If you have the law on your side, argue the law. If you have neither, bang your fist on the table and raise hell, basically. It sounds like USDA might be onto their third option, where they're almost out of other options, so that's all that there is left to do.
Well, it's yeah, so it's let me be clear here. So like, USDA isn't this is the methodology they have, and
Yep.
they follow it, and we love when things are consistent, right? So, we love consistency. And so this is their opportunity to go back and revise previous quarters grain stocks or the 2023 yield. And given the June stocks report, like I think we have to anticipate some big shifts here.
Yep. Well, Ben, looking out toward the rest of the week, we do have some other notable things coming up, like the winter wheat crop insurance cutoff date coming up this coming Monday, September 30th. But Ben, what else should farmers and ranchers really be paying attention to?
Yeah, so you mentioned the winter wheat update or crop insurance deadline for winter wheat next Monday. It's also the deadline for margin coverage for spring planted crops. So if you're thinking about margin coverage, which includes input costs for 2025 corn and soybeans, even though we think of March 15th being the crop insurance deadline, for margin coverage, it's actually September 30th. So you've just got a couple of days left if you're interested in margin coverage for next year's corn and soybean crops. Um, it's also there's just a lot of reports next week. A lot of reports, a lot of macro data coming out. I penciled in our newsletter here that Thursday, this coming Thursday, the 26th, Michelle Bowman is set to speak. I usually don't put these in the newsletter, but given that she was the lone dissenting vote at the Fed meeting, and she was the only Fed governor since 2006 that has dissented against the policy, or these Fed meeting policy updates. I thought maybe that was of
Seem
note.
notable. Yeah.
Yeah, noted. And then the other thing that's hanging out there that I just want people to be aware of is like we have another labor dispute negotiation that could impact agriculture kind of hanging on the horizon. The longshoremen for the East Coast all the way down into the Gulf of Mexico, they're at odds with port owners, and if they don't reach a negotiation by next Monday, they're set to strike on Tuesday. The reason that's a big deal is we're trying to get corn and soybeans down the river and out export ports. This is a big period for especially soybeans, and that could be a headwind hanging out there. Or excuse
So,
me, that could be a headwind hanging out there that maybe hurts our markets a little bit in the week ahead.
all right. Well, Ben, maybe a preview of what we could talk about next week, depending on how things go. Really, we'll talk about it either way, but the tone is
Sounds great.
what that could shift. But viewers, listeners, if you'd like to learn more about us and what we do, or our sister program, the weekly livestock market update, you can do so at brownfieldagnews.com. Ben, thanks again. I'm Will Robinson on Brownfield.